Look at this. We have no Adam again.
No Adam again.
We do have Nick with a, I don't know, is that a newer haircut there?
A little new haircut. This is actually, old school style haircut for me. So
summer cut. The summer cut. Yeah. A little lighter on the top.
Yeah.
I'd show you my summer cut, but there's not really anything left to cut up there.
I thought that's what you were doing.
Oh, that's it. No, this is more of a, I don't even know what you'd want to explain. I'm trying to look like my dad, I guess. I don't know.
Oh, okay.
Go with the Perri family horseshoe.
Yeah. He's a good-looking guy.
Hey, most people have horseshoes up their ass. I got one on top of my head.
How many people can say that?
Not many, unless their last name's Perry, because there's a whole lot of us. And I will make sure to post some photos from a wedding that we'll be at on Saturday, where there will be lots of Perrys with very, very similar hairstyles to me.
All right. We'd be interested in seeing that.
Yeah, we'll see. I can promise you this: you're not going to find many people over 6 foot tall at that wedding either. So
that's like an Oosting wedding.
it is. I have our promo cut for this episode. I made sure to make you the tall guy.
I appreciate it. I don't know if people caught that or not, but that was a first timer for me.
I was like looking at it, I was like, you know what? Let's just swap these around, because Nick's always
make me feel good.
Yeah, Nick's always like, I mean, listen, I'm vertically challenged as well, so I know how it goes. But speaking about weddings and in the market and summer hair and all of this, let's rewind a couple of years, and we heard this whole marry the house, date the rate.
Yep.
Rates will go down, rates will go up.
Yep.
We've heard 800 different variations of that. I think we even did an episode, like I did one with Harris maybe, about marrying the house and then divorcing your spouse type thing.
Ouch.
There's lots and lots of programs and ideas and strategies to acquire houses, right? We've talked through lots of different loan types like USDA, VA. A couple weeks ago with you, we talked about buying that ugly house and making it yours with a 203K loan.
Yep.
With rates kind of staying in this middle 6, low 7 range here, and most economists forecasting that's going to go out through the remainder of the year. If monthly payment is your concern, we have other strategies to achieve a monthly payment goal in your first 1 to 3 years of home ownership. It just takes a little bit of creative strategy. And you and I were talking yesterday for a minute about homes in some areas may not be moving as fast as they were. And so there's two options, right? You work with buyers and sellers. So when you're working with sellers, you have essentially two options. If your house is, well, 3 technically, like you just said, you don't want to sell it. But if you're a motivated seller and you're not receiving showings, you're not receiving offers, you have the opportunity to cut the price, or maybe to provide a closing cost credit or an incentive to make that house more appealing.
Yep.
And these costs we've talked about just generally, we'll go through them. These are not an offer of credit. They're not a guarantee of anything. All of the disclaimers about when we talk about interest rates and all these programs that are required, they don't apply. This is a simulation. Always get a loan estimate. Always have a conversation with your mortgage guy and your real estate professional on this. But there are ways that we can lower, or not even lower, the seller can cover the difference in interest payments over the first 1 to 3 years of home ownership.
Yep.
It was something that was very, very popular a long, long time ago. It kind of popped its head back up in October 23-ish when rates were really, really high. But what do we do now when rates are still in an area where people are concerned about what their monthly payment is, and then you're factoring in that with home prices? Well, let's talk about temporary buy down.
Mm-hmm.
It's not an adjustable rate. I think that's one of the biggest things we talk to first-time buyers. They get confused or get scared because, it's an adjustable rate.
Mm-hmm. This
is not the case. It is a fixed rate mortgage. And what we do is we use some of that seller contribution to fund the difference in interest rates. So there's the garden variety, you name it, you can pick them out. 3-2-1, 2-1, 1-1, 1-0 buy down. What do those mean? Well, 3-2-1 buy down doesn't mean that your rate goes from 3 to 2 to 1, but it does mean that if it's let's try to get one of those. But 3-2-1 buy down It's the most aggressive one. And that means that the interest that you are going to pay as a buyer in that case is going to feel like it's 3% lower in the first year of home ownership, 2% lower in the second year, 1% lower in the third year. And then when year 4 comes around, you now have an opportunity to either refinance if rates are more favorable, or you're just at the actual fixed rate mortgage
at that current time.
At the time from today. So today, gotcha. If the start rate, or not that's good armed adjustable rate talk.
Yeah.
If the rate today on a 30-year fixed mortgage was 7%, in year 1 in this case, you would pay what feels like the equivalent of 4% interest rate. The seller would be paying the difference with that seller contribution to fund the difference in interest due. In year 2, 5%, year 3, 6%, and then year 4 through year 30, you could keep that 7% rate.
Okay, so you got 3 years of really a much lower rate, and basically who's buying that down would be the seller, technically,
yes,
in a sense, because you as a buyer you're putting an offer in and you're asking for a credit, whatever that credit might be, in order to get that that rate drop. So it's not coming out of the buyer's pocket; it's coming out of the seller's pocket to do that for us. So now you got 3 years of
3 years of real savings here, right? Yeah. So let's put our pretend entertainment hats on here. So on a $300,000 purchase with FHA financing, the 3-2-1 buy down here, if our rate is our actual rate is a 7, that cost is about $13,300. So a little over 4% of the purchase price.
It's pretty good.
Yeah, I mean, I think that we see homes typically sell between 95% and 105% of list price.
Yep.
So asking for a 3 or 4% lender or a 3 or 4% seller credit, I don't think is unreasonable. Mm-hmm. Again, it comes from the seller.
Well, what we're seeing nowadays is sellers are more willing to do stuff like that. You know, because the market's shifted and changed a little bit. I mean, it's still a good market. Things are still selling, but it's becoming more of a 50-50 buyer-seller market instead of a heavy buyer or a heavy seller, which it has been, recently in the past few years. But
absolutely. So
don't think that you can't get away with something, some kind of negotiation there.
Yeah. And again, we qualify you and we make sure that you're going to be able to afford the regular payment. Mm-hmm. We don't use this to skimp on qualifying here. But in year 1 in that equation, Nick, you're talking about $500 a month less in a mortgage payment.
Yep.
Year 2, it's just under $400 a month, and year 3, it's just under $200 a month,
which is really good. And then most of the times people are possibly getting pay raises or maybe better jobs in that time period where they're making up that difference. So when that year 4 comes, hopefully the rates have come down. If not, you stick at this. If they went up, you're still not at that rate that went up. You're at the current rate it was 4 years prior, or 3 years prior to that, or 4 years prior to that, whatever it be at that point in time. And then you're at, if it comes down, great. You just go ahead and refinance, or you can refinance 2 years after that after it comes down.
Yeah, and you can refinance during this process too. There's no requirement that says you can't.
That was my next question.
And that money doesn't disappear. It's just in an escrow account with the loan servicer. Mm-hmm. So it's just where it reduces your payoff.
Okay.
So the money doesn't just go away. But let's talk, maybe in a more competitive bidding situation, maybe asking for 4% seller credit, it might be a little too much.
Yep.
So let's talk about maybe a 2-1,
okay,
which is going to be, again, start rate 7. The impact of the rate you're going to feel like you're paying in year 1 is 5 in that case. And then in year 2 is 6. And then, year 3 through 30 is back to that 7.
Yep.
Even there, you're almost saving $400 a month in that first year. So if I told you your mortgage payment was going to be $3,000, you're paying $2,600.
That's a good savings right there.
Exactly. And we think about this, like you work with lots of investors that have landlords.
Mm-hmm.
There's always the consistent churn of rent going up. We hear it all the time. One of the main conversations about buyers wanting to buy is because my landlord decided he's going to sell the house or raise my rent, right?
Yep.
So here's an opportunity to keep your rent, your housing expense, we'll say your housing expense, equal to or nearly equivalent to your rent.
Yep.
For the first year or 2.
Yep.
And then your rent's going to be going up. Well, so your payment goes up a little bit.
Yeah.
And then the last one's just a 1-1. So, year 1 and year 2, that 7% feels like it's a 6%.
Which is a good drop for
Yeah, I mean,
that's a really good drop.
I mean, it's $1,800, of savings for a year there. So it's not huge, but it's still enough for in this case $2,300. Like,
yeah,
that's the seller's problem.
Yeah. Well, I mean, it's a different way than because we talk about it all the time. People go on Zillow with the Zillow calculator or whatever different thing online, and they get their payment and they all say like, oh no, I can't do that. But this is an option that they're not talking to you about. That's why you talk to people like Tony that can walk you through stuff like this. I mean, this is good stuff that you don't see every day. Us in the industry, we kind of know this stuff. You more than us. You can explain it better, obviously, but we understand these things are out here. But I mean, to the average public, maybe you're not thinking that. So this is a good way to get that payment down. Say they do the 3-2-1 in 3-4 years whenever that comes up, if they don't want that 7%, well, guess what? You just had 3 years of payments. Most likely the housing market has gone up. Maybe you sell the house.
That's it. You try it on.
So, right.
So it's like, so
I mean,
dating the rate in the
scenario,
house, it's, it's like a 3 years of a one night stand with the house or something kind of perverse and spicy like that. We're trying to drive up the ratings on this thing. We'll talk dirty.
There we go.
But it's a strategy that we can put together. We need to work in lockstep with the real estate agent on how to execute that so that they know when they're drafting the contract and the offer, they understand what they need to ask for seller paid closing cost credit, so that we can fund this appropriately. It's really a pretty easy calculation on the mortgage side. But it's based on, price and then your loan amount. So we could walk through that. But if the rate is too high, or rates are too high, is your concern or your objection, well, how about we leverage the seller to eat that rate for a minute?
And like we said, it's not that it's going to happen with every single deal that you do, but it's more willing to happen or able to happen now than it was for years past. So I think now what we're kind of going now is kind of getting people to understand how the market is now compared to what it was, because a lot of people were used to how it was. It takes a little bit to catch up to how it's changing and evolving a little bit. So
it's the interest rate world and real estate, I think it's a pendulum, right? Like it's a lot of, swing this way,
especially lately.
And we're finally starting to see it just kind of like the left and right variances narrow down into a very singular area, and it becomes imbalance, which we want to see balance because it makes it fair opportunity for the buyers. Sellers get fair money for their house, and people begin to transact.
And we love that.
I love transactions. I don't know about you.
Transactions are beautiful.
Talk's fun. Transactions are a little bit better, but if trying it, or the fear of that monthly payment, maybe what if you're in a situation where you're in a spot where your income is going to ramp up over the next 2 or 3 years too, right? Like,
and typically it does,
Yeah, so you're on a career path that you're going to get your master's at the end of next year. So you're a teacher and you're going to go from $58,000 to $74,000 a year. Like, now your payments ramping up just in time with your raise, and your monthly budget. It's a pretty weird thing. It always seems to manage to just work out.
It typically always does. When people have to do something, they can get it done, and it typically works out.
Yeah, and so what do you do? So, okay, I'm saving an extra $300 or $400 a month in my first year. Let's set some money aside. Maybe that other money that's being set aside allows you to invest into something, or to maybe set aside some money for a repair, or an emergency fund for a roof or HVAC or something like that.
Yeah. Here's a question for you. So they're in this scenario, I think would you run the numbers off $300,000 instead of, or a $3,000 payment, and maybe there'd be a $2,600 payment on the 3-2-1 buy down. Now, say someone does that, right? They get the seller to cover that for them. Can they if they say they're comfortable with that $3,000 payment, can now they take that $400 for that 1 year and use that towards the principal?
They could. The math on that actually just works out. In that case, if they were comfortable with that, we would probably look at doing a permanent buy down.
Okay. All right.
The math nearly always maths in these equations. So the money that you might be saving in interest, it's more than likely it's coming into the purchase price equation, which now is
Gotcha.
your loan amount equation. But yeah, you could, like, there's no rule that says that you can't pay more.
Yeah.
So you could direct it. You know, I guess the better question, or maybe the more realistic situation there is after year one, during year two, you get that raise.
There you go. That was my next.
So can you all, like, there's no prepayment penalty on this. So you can always direct additional money towards principal, pick up equity. It's a very fluid situation, but the situation doesn't start the conversation. None of it starts without a conversation.
Yep.
Reach out to a pro.
Yeah. So you can have the seller buy down your rate. It doesn't happen all the time, but say you get in a situation where you need that, you have the seller buy down your rate, you get your payment down a decent amount cheaper than what it would be at the average rates that are going on. And then, maybe year two, maybe you get a different job where you get a $10,000-$15,000 raise, or you get a raise at your job. Now you've got a lower payment than what you would have. You could take that extra money, you can set it aside, you can do other stuff with it, whatever. But of course, you can also apply it towards the principal and start, buying down your house much quicker.
That is the name of the game.
Yeah.
What else we need to cover here, Nick?
I don't know. I think we covered a lot today. I mean, the market is, like I said, it's a 50-50 seller buyer market right now. Things are still moving, more deals. There's more deal making going on, more and more as we see. So sellers are more willing to play ball, and buyers as well. So, but I think this is a great option. I mean, we get this all the time with people. Well, the rate. Well, how about this? Hopefully for 3 years, maybe 2 years, or maybe even a year, we can get you at this point in time
for $6,700. We could probably make something happen. And go ahead.
Well, I was going to say, so you get the rate down for 2 years, 3 years, whatever it could be, and hopefully, like what do we hear all the time? Well, I'm going to wait till the rates drop, that's a conversation for a different day, because I hate that. Because as soon as the rate drops, what happens with the home prices?
They continue to
go up, and then they're going to say, well, I'm going to wait till prices come down. The only reason the prices come down is because the rates go up. So, I mean, I'm going to wait till the rates come down. Well, we can get your rate down. We can get you at a more buyer's market price. And then if that rate does come down, you just refinance it. You got yourself a good deal.
You're buying yourself an insurance policy for between 1 and 3 years. That's the way you should look at it. I have 1 to 3 years of trying this house on. Do I love it? Is homeownership for me? It's ramped up. Whatever, wherever you end up, you always have the opportunity to sell it. There's no prepayment penalty with this. There's no gimmicks with this. This works on owner-occupied financing, conventional, FHA, VA, and USDA. Yeah. So the whole gamut of loan products there for you on owner occupancy. And it's, like I said, it's a one way to fix that concern, right? If we hear all the time, I want my payment to be this. Well, here you go. Here's how we can get that payment to be that for the first year, or maybe the second year. And there's a couple other variations besides 3-2-1, 2-1, and 1-1. There's a 1-0, a 1-1-1. There's other splits and things of it, but these are the three most popular. So 3-2-1, 2-1, and 1-1. Again, not an adjustable rate mortgage either. Can't stress that enough.
I think that's the biggest thing. It's not an adjustable rate. It's a fixed rate for 1 year. If you get the 3-2-1 1 year, fixed rate for the second year, and a fixed rate for the third
it's
year.
Always we're just taking the seller's contribution and applying that to the difference in interest.
Yep.
No prepayment penalty on it.
Simple stuff.
Anything else? I know we covered quite a bit there. What we got, U.S. Open this weekend. We got Father's Day, U.S. Open. We got all kinds of fun stuff this weekend.
Yep. You got any plans for that? Or are you going to be watching the U.S. Open for your Father's Day?
I'm going to hope. I'm going to be in St. Clair Shores, Michigan this weekend. So
you're going to Michigan too?
Yeah, Pierre, Michigan. We'll be got a family wedding up there for one of my good cousins, Scott, who occasionally watches, and
there we go.
It's my Aunt Angie's son.
Scott.
Yeah, exactly. And his got an awesome bride. And then it's my Aunt Angie's son, Scott. So my Aunt Angie, big fan of the show. Shout her
awesome.
out.
Right.
I'm sure we'll be getting in a lot of trouble and we can yell at her frequently on Saturday. So we'll do that.
That can happen.
But you got Michigan on your radar here this weekend too, right?
Michigan, I think we're not sure where we're heading yet. Might be New Buffalo, St. Joe's area, something along those lines. So right over the border there.
It's a business trip for you now.
Business trip, yeah. We rock and roll. We got stuff going on in Michigan. Maybe I'll make a sale.
Yeah, the tri-state agent. I like it. I'll try anything in any of the states.
Well, I think we got to put a disclaimer out because we did not color coordinate today. This was not a plan.
I did see you yesterday.
I think we look good on screen. That's what I'm thinking.
Coral looks good on you,
Yeah.
All right. Well, if you got nothing else, we'll get out to this sweaty, muggy Wednesday here. Maybe summer's here for real.
I love it. You know,
And
get back on the boat and actually enjoy the summer.
We'll see if Rory makes the cut here at the U.S. Open. I think he shot at 81 in this practice round. So see if that happens. We'll see what happens with Scotty Scheffler and all of that. And like I said, if you ever got questions on this stuff, they can reach you, Nick, at
630-284-9624. Always available on our social media at Realtor Nick Oosting.
And if you ever get tired and you type in the wrong number and go 630-284-9729, you'll get me. So
you might get Tony. Just don't call him Saturday night.
Yeah, you should call. You might get better answers. Call.
Yeah.
Maybe not this Saturday night. I'll be a little bit busy, but we're always here to help you guys. And again, we can't stress enough. We can't help you if you don't reach out and ask us.
Absolutely.
Till next time.
All right.
I'm done. Cut the show.